Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures pages on the screen now. These can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both the positive and the negative news. And we got some negative news today, guys, which Quinton's going to be talking about with that we actually think it's not so bad as the market has thought recently, but he'll be talking about the leach pad failure up in the Yukon at the Victoria mine, or the company's name is Victoria. Anyway, he'll be telling you all about it. Anyway, our videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. These securities do not represent an entire portfolio. The securities we discuss herein, in an aggregate, they may only represent a small percentage of a strategy of a Crescat strategy's holdings. The issuers discussed may or may not be held in Crescat's client portfolios at any given time. This video is not intended to be, nor should it be construed as an offer to sell or a solicitation of an offer to buy any security. If you enjoy our videos, please click on the like button and make sure you are subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen now and can be found on our website at crescat.net. So let's get started. So this is one of Tavi's charts that he's shown in the past, and Tavi's going to have a pre-recorded presentation because he's in the mountains and his internet connection's a little spotty. We'll see. We got him on here too, but we'll have a pre-recorded session. And this chart didn't make it into his session, and so I'm like, well, heck, I want to show it, so I'm showing it here. And this is and look, Bitcoin has been coming down the past few weeks, and look at how it's diverging from the NASDAQ. This is, one of these technically correlated kind of indicators. People think that that Bitcoin is an alternative to gold. We don't share that same view. In fact, gold and silver have been up recently as Bitcoin's been coming down. That's much more pleasing to us to see. But this is an indication of this Bitcoin kind of being a lead indicator, perhaps, for a bigger fall in the frothy, overvalued mega cap tech and NASDAQ names, showing this divergence here. Let's go on to the next. Now I've shown this chart the past few weeks, and we have a whole letter, building off of this, and so I'm just going to go through it quickly again. NVIDIA recently reached 11.7 times GDP in terms of enterprise value to GDP. This compares to Cisco at its market peak at the peak of the tech bubble in 2000, more than twice as richly valued compared to the overall market. And it comes in at 41 times sales. Cisco was 30-something times sales at the peak of the tech bubble. Let's keep going here. I don't want to waste a lot of time. But of course, I've shown this too, and look, this tech bubble just keeps getting bigger. It is insane. The top 10 mega cap tech stocks today, because of this AI euphoria, represent 60%, more than 60% of GDP now. This has gone to a new high, higher than that late 21 top, more than twice as high as the tech bubble peak when those top 10 stocks reached about 30% of GDP in aggregate. And the valuations are just, stretched across the board. Let's go on to the next. people will say, oh, but the fundamentals are still strong. Well, let me just hop in here and talk about this Sun Microsystems chart. So Scott McNealy in 2002, after the tech bust in the early 2000s, he basically wrote a letter to shareholders saying, what were you people thinking buying my stock at 10 times revenues? And he said 10 times revenues, to give you a 10-year payback, I would have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. It assumes I pay no taxes, which is very hard. And that assumes that you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64 a share? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? Of course, this was after this stock had totally crashed. Some of you might remember that Sun Microsystems was one of the biggest positions that I built among my client base back in 1998, and along with Qualcomm, and they were two of the leaders back in the tech bubble. We'd sell half every time the thing doubled, and I got out too early in both of those stocks, but I didn't completely get out until March of 2000, and then I got all my clients out except I was still a broker back then in March of 2000, and we had just launched our first strategy, the large cap portfolio as well. But I was also a broker, and so I was a position builder type broker, and so I build positions in stocks among the brokerage clients, and these are my two largest positions. So calling all the clients, getting everyone out, finally after we'd already sold half and half and half every time the thing doubled in March of 2000, because it was ridiculous. A couple of clients didn't want to get out, of course, and that was their problem. So after the fact, Scott McNealy is saying, what the heck were you guys thinking? This was a 10 times revenues, a computer company. Look, we have NVIDIA at 41 times revenues today. Anyway, let's go on to the next. This is a chart that Nathaniel did, just showing how valuations, a combination of price to earnings, price to cash flow, price to sales, price to book in aggregate, on average, are as high as they've ever been, as high as the 2000 top, as high as that 2021 top. And here we are again. And people will say, well, the fundamentals are really good right now. The growth rates, the margins of these mega cap tech stocks that are driving this overall S&P valuation. But look, if the valuations are really that, if the fundamentals are really that strong, we should be calling into question the sustainability of those things. If profit margins are historically high, if looking at trailing growth rates, those things are still really high. We really got to question, are we at a peak inflection in the economic cycle? And if so, we should be putting a low multiple on those things, not a historically high multiple. And that's the same lesson that Scott McNealy was trying to say after the fact. And so we just, this is extraordinary risk. We have an extraordinary frothy market today. It's something to watch out for. Let's keep going. Rising inflation expectations. So this is in our letter, and again, I've shown this chart before, but the Fed is losing control of long-term inflation expectations, and we have to be cognizant of what that means, because inflation expectations are a self-fulfilling force, and the Fed has been trying to keep them anchored. You hear it say all the time, we believe that long-term inflation expectations are well anchored. Well, does this look like well anchored when you look at the Michigan survey of consumers and their 5 to 10 year inflation expectations? At the mean, it's up to 5.6% over the next 5 to 10 years. This is what coming unanchored looks like. And now let's go on to the next. If we look at the distribution of these expectations, you can see that it's the bottom third of households based on household income that has the highest inflation expectations, up close to 7%. These are the people that are hurt the most by rising inflation, and then the middle income, and then the top one third of household incomes has the relatively lowest inflation expectations, but they're still rising. You can see, but this is the group that's responsible for the allocation in the securities markets, and this is the group that is still historically underweighted to inflation in terms of their investment positioning, underweighted to commodities, in particular, underweighted to gold. And this is the setup that we see for the rotation of these folks into these out of the overvalued segments of the markets and into the undervalued commodities. Still ahead. Let's keep going. This is one of Tavi's charts that we show in the letter. We have the trade. He probably showed this chart in his presentation, so I'm not going to dwell on it too much. But we have twin deficits. The trade balance report, which just came out, showing the trade balance declining again due to rising imports and rising import prices. Let's go on to the next. But it's not just the trade balance. We have a twin deficit, a current account deficit, and a fiscal deficit. And combined, the current account deficit and fiscal deficit are now more than 10%. This is the level that we saw going into the global financial crisis. Of course, during the COVID pandemic, it got even worse. And we're supposed to be in an economic expansion, and yet we're running 10%, a 10% twin deficit. This is highly, highly inflationary, and people are not positioned for the inflationary consequences of what this means. Let's keep going. Time to build a mine. One of the biggest imbalances that we see is the imbalances in the commodity markets due to the underinvestment in commodities for the last really since 2010. It's been like a 13 since 2011 at least. It's been a 13-year bear market period for capital investment in mining and exploration and building new mines. The world needs this stuff. The world needs metals if we're going to have this new modern economy with the EVs and the green energy economy and all this fiscal spending going into this, all this deficit spending. We need metals. We don't have the metals. It takes 16 years to build a mine, and we haven't had that capital investment for the last 14 years. Let's keep going. Part-time employment for economic reasons. So this is a chart that Nathaniel put together here, and it's showing that when you see rising part-time employment for economic reasons, that's when people are being forced to go back to work and to take on a second job to afford the cost of living. When do you normally see this? Historically, when has this always started to rise? It has always started to rise at the beginning of a recession. And of course, it's inflation, that it's the cost of living that is forcing people to take on these second jobs. And this is something that the markets still don't have a handle on. I mean, the Fed has everyone fooled that inflation is going to be under control. At least everyone responsible for allocating, portfolio investments. But the broad population is not fooled. They know that inflation is out of control already right now, and this is one of the catalysts for the recession. Let's keep going. Similarly, when the unemployment rate crosses above the 24-month moving average, you might say, oh, it's just a little blip. And of course, we had the unemployment numbers, surprising, a little bit higher unemployment again with the data that came out this morning. And what is this? It's a signal ahead of every recession. So let's keep going here. So, Tavi's shown this chart before. I'm just going to show it again. There's, family offices only allocate 1% of their portfolios to commodities. We believe we are at the beginning of a new secular bull market for commodities. We see a rotation coming out of overvalued mega cap tech. This AI, AI is wonderful. The advancements in AI are highly disruptive, however, and we believe that we are going to see creative destruction. That's what the letter is all about. It's about creative destruction. It's a term coined by Joseph Schumpeter, who was a Austrian economist. I was just in Vienna on vacation last week, and we learned about the Austrian economist. And they, creative destruction is real. The economy can only support so much overall market share for the existing incumbent entrenched monopoly technology companies. But the AI is a new disruptive force. If you have any doubt about it, just go look at Perplexity. Start using their internet search engine. It's an LLM based AI search engine, and they are going after Google's business model and monopoly on search. No advertising at all, but just a well summarized, with links to the web pages and summaries of those web pages. No ads. And super fast. This is VC funded. It's still a private company, but the monopoly oriented mega cap tech companies, and their excessive market share and valuations. This is not something that can be sustained if we're going to have overall real economic growth and real progress from a new technology like the advancements in AI to grow the overall real economy GDP pool. There needs to be disruption of the incumbent monopoly based companies. And so I think people are just making a huge mistake in the valuations that are being attributed to the mega cap tech stocks today. It is exactly like the internet bubble. People will say, no, it's nothing like the internet bubble. BS. It's exactly like the internet bubble. And there's a lot of unwinding here to go. So look, we're very bullish on commodities. We see a great rotation out of the mega cap tech and the overvalued financial assets and into undervalued commodities. We see a new commodity bull market ahead. And that's how we're positioned. So we're going to flip over to a pre-recorded macro segment by Tavi now, and then we'll get on to
labor markets numbers that came out today, which I think confirm further cracks in labor. Here is the presentation on the macro side. Especially, I think it's relevant to speak about the labor markets numbers that came out today, which I think confirm further cracks in labor markets. We're starting to see a trend here of weakening labor data over the prior weeks. And I put this chart together because in June 28th, the University of Michigan also came out with their long-term inflation expectation number that you can see in the white in the slide, in this chart. You can see inflation expectation has been rising significantly over the last years. In fact, it was the largest print that we've had since the 80s, I believe. And on the red line, you can see the economic surprise continues to actually surprise on the downside. For those that don't know what the red line really is, it's just looking at actual data relative to what was estimated. And the data is coming significantly worse than what was estimated. Therefore, this red line continues to dip lower. And so this is a classic stagflationary type of chart in which puts the Fed in a very difficult position. It has to pick between their dual mandate of inflation stability and labor market stability. As we see economic data weakening, I would suspect that the Fed is going to pull the card of the economic weakening and therefore actually starting to ease their monetary conditions. And the main reason for my view on that is because of the interest payment on the debt, that it continues to surge as we see interest rates remaining higher for longer. And so that to me will more and more become a relevant part of monetary policy as we move forward. So let's go to the next slide, in which this next slide, you can see the cross-asset volatility that is historically suppressed. I mean, I can't recall in my career at least a few times that we've had a period like this, and those are usually sort of the calm before the storm types of environments. And you can see here on the top one, you're looking at credit spreads. So you're looking at what's the difference between corporate bond yields versus the treasury market. And you can see clearly you're not receiving much of a premium for taking additional risk in the market of corporate bonds. The second one is looking at VIX. You can see VIX for equity market volatility has been also historically suppressed. The third one is looking at FX volatility, completely different asset class, and you can see here as well that it's also certainly historically suppressed. And the fourth one is oil, in which has been sort of moving higher recently, but volatility has also been very low. I would suspect that volatility will pick up significantly, and the main reason for that is now I'll develop it here in the next few charts, but let's go to the next one. And so you can see in this one that despite the fact that volatility across all these asset classes are low, the bond market volatility remains high. That's the red line. So you're looking at the MOVE index. It's a Bank of America index for looking at the bond volatility, particularly in the treasury market. And you can see that there's a divergence between the two. And the divergence is not from, the prior month or the prior 2 months. It's been the case for a while. We've seen this weakening liquidity in treasury markets caused by many reasons. I would perhaps say a few of them. One of them being the central banks have been participating less and less in the treasury market relative to the amount of issuances, and obviously the amount of spending we've had here in terms of the government fiscal stimulus that has been creating this flood of issuances of treasuries, creating as well an increase in volatility. And I would suspect that this volatility in the bond market would eventually actually cause further volatility as well in other parts of those other asset classes. So I think that's those other cross-asset volatility is poised to increase as we see bond volatility staying higher for longer. Let's go to the next chart. And you can see sort of this index is the U.S. government securities liquidity index, shows as well that liquidity has been poor in the treasury market, which supports the idea that the bond volatility should also stay higher for longer. And at some point, we start to see this sort of infiltrate other parts of the economy. As interest rates stay higher, you start seeing other businesses and even the government start rolling down their debt. And as we see that occurring, it should actually also increase the risk for defaults and other things. In fact, if we go to the next chart, let's go here. That's it's interesting the fact that sometimes we think about it, but we've seen this hiking cycle by the Fed. Is it normal to see the volatility suppression like that? Like have we seen this in the past? And that's the idea of this chart specifically. So it's looking at basically a measurement of volatility or measurement of complacency, looking at the credit spreads in the first panel of this chart. So low means complacency is high. And below in the second panel, you can see the Fed funds rate, which shows that we've been in an interest rate hike cycle recently. And as you can see here, it's very normal to see as we see the hiking cycle progress, volatility tends to be suppressed. And then there's a lagging effect that ultimately actually causes volatility to explode to the upside. I think we're, at the final moment of this, And we're starting to see this probably starting to show signs that we're going to see an increase of volatility that will also most likely also impact the credit spreads to widen significantly. Let's go to the next chart, because if you see here, there's a number of bankruptcies starting to pick up, and this chart is basically looking at the number of filings of bankruptcies on the very top of the chart, and you can see here in blue bars is so far year to date relative to prior years. It's not a huge increase in that basis, but we're seeing that the rest of the year it hasn't really picked up at that front, but in the filings by month, you can see that with more granularity, you can see that they're starting to pick up significantly over the last years here relative to 2020 when we had the COVID recession. We saw a print of 74 filings by month, and now we're at 69, 62. So clearly the trend is higher in bankruptcies. And if you dive in further in the next chart, you can see it that by sector, consumer discretionary is the one that is really driving this. Consumer discretionary, if you know, the consumption is a huge part of the economy in the U.S., but not only that, consumer discretionary businesses have never been so levered. So when we calculate in our own models amount of debt in the system in the consumer discretionary sector of the market, it is the most levered it has ever been. And so it makes sense that we're seeing bankruptcy filings actually increase, mostly being caused by that part of the market because those are the companies starting to roll over the debt and starting to see that increase of interest rates having an impact on how they service that debt moving forward. And so we're seeing those bankruptcies come on the back of those of this macro backdrop that we're seeing. Let's go to the next chart now. And so we have here, this next one is, to me, perhaps maybe the chart of the week, which is basically looking at the number of stocks that are beating the S&P 500 on a percentage basis, and which is the lowest number we've seen since 1974. This speaks volumes about the breadth of the market. I mean, the breadth of the market has been weakening, as we all know. There's many measurements we can see on the front, even the percentage of stocks that are above the 200-day moving average in different indices, not only NASDAQ, but also the S&P 500, Russell 3000, you name it. All indices, broadly or less broadly speaking, are showing weakness in the breadth of the overall equity market, in which it shows that the lack of leadership will eventually give in. And as we see that, likely very similar to what we saw back in the early 2000s too, when we've had that lack of leadership eventually causing the market to weaken significantly, and so showing large fragility as in the overall market. Let's go to the next chart. And so what is one of perhaps the most important thing happening this week, in my view, was this breakout on the 2 versus 30s, or the yield curve has been basically steepening recently. As you can see, there was a support, or I should say a resistance line that recently was broken, and the yield curve has been steepening recently, perhaps because of some of the situation with the debates and some of the changes in markets in terms of the likelihood of who is going to win in elections. But really, in my view, it a lot more than that. It has to do with this steepening of the yield curve is the recession signal. I mean, it's the fact that we're seeing a very inverted yield curve, that we're now the uninversion process, or the steepening process that we see, is usually a sign, or I should say it's often, and I don't think it has that. I mean, every time we've seen an inversion to the degree that we've seen so far, and then a steepening move, every time has actually caused a recession. And so what we're likely to see, however, is that the steepening of the yield curve can also be seen as a healthy environment. So be aware of the analysts, the wave of analysts that are likely to come out to speak very positively about this development. And I would say that this is a very strong and reliable recession signal. So I'm paying very close attention to this. I think we're just at the beginning of an acceleration to the upside of the yield curve. And let's go to the next chart, because I break down a little bit of what this really means. Is an inflationary bear steepener. We're seeing on the front end a decline of the 3-year. This is actually in 1973-74 stagflationary environment, when we saw a decline of the 3-month year or of the short-term rates. We saw an increase on the 10-year, and that was really causing the yield curve to actually steepen significantly. I think this is very similar and perhaps even more pronounced on the 10-year increase because of the flood of issuances that we're seeing as well. So this is another way of really measuring how much inflation is in the system is actually paying close attention to the yield curve and the shape of the yield curve, but also what's causing the yield curve to move. And this is a bear steepener that we're seeing recently outside of today, that actually has been being really forced by this pressure on the upside of the 10-year yields and 30-year yields and other long end of the curve. Let's go to the next chart. This next chart, in line with the same upward movement in the yield curve, we're seeing oil also break out. This is also another inflation trend that I think is just starting. A lot of people were suspecting that we would see oil decline as we had the recession, I should say elections coming up, because usually you tend to see some political moves towards trying to avoid oil prices to increase. My view is that there is almost no president, perhaps, you can point to that have that much of an involvement on impacting oil prices lower. In fact, I think that this is very likely to see an acceleration to the upside in oil prices that will put the Fed in a very difficult position. In fact, the weakness in inflation numbers we've had recently are actually on the back of low energy prices. And I think that this is changing the picture quite a lot, because energy prices could actually be breaking out to the upside in a big way as we see this chart developing forward. Let's go to the next chart. I'm almost done here, guys. You can see here Japanese yen is starting to diverge from the interest rate differential. The point of this chart is that the white line is looking at the Japanese yen depreciating. So the higher the white line goes, the lower, the further the depreciation of the Japanese yen versus the dollar. And it's starting to diverge from an interest rate differential, meaning the 10-year yield in Japan is actually moving faster than in a higher way than the U.S. 10-year yield. And therefore, we're seeing the differential between those two yields is starting to diverge. And that really shows me that the Japanese yen is starting to get ahead of itself, I should say, or the dollar yen is getting ahead of itself the other way around. And I would suspect that the Japanese yen could be trying to find a bottom here. I know this is a very contrarian opinion. In fact, if you go to the next chart, you can kind of see that the positioning on the futures market is also very extreme. It's near record positions of people betting that the Japanese yen will continue to fall. So basically what I think is happening is this is not just a case with the Japanese yen. It's happening across many other dollar pair or FX pairs, in which I think the dollar is actually, I would suspect that the dollar would have been a lot stronger on the back of such a strong interest rate differential, one of the strongest interest rate differentials we've seen in history, particularly in the short end. I mean, what the Fed has done so far with raising interest rates relative to other countries, you would suspect that capital would be flowing even more back into the dollar, and we're not seeing that. And to me, that's a very bearish environment for the U.S. dollar. In fact, if you go to the next chart, not only the Japanese yen is in near record bearish positions, but the Canadian dollar is also looking like a very crowded opinion of most investors and speculators by shorting the Canadian dollar. And this is what creates and sets the stage for a big change in particularly in a short squeeze, right? You have all these people shorting one currency, and then it gives all this room for a shift of opinion and stance. That once that happens, you tend to see a surge of the instrument And I think the Canadian dollar could see certainly a further appreciation from here. Let's go to the next chart. And so a few things. The U.S. trade balance is probably one of the most important things going on too as well that I would point out. We've seen this downward trend of trade balance. The trade balance is a significant thing because it may seem irrelevant, but when you're running a fiscal deficit of over 6%, and on top of it, you're also running a 4% trade balance deficit, it adds to about 10%, which is the next chart, and it shows the U.S. Twin deficit issue that includes the current account and the fiscal deficit relative to GDP, where the U.S. is structurally running a very negative twin deficit relative to GDP, which is below what we saw in the tech bust, and now not too far from the global financial crisis. And I think that's what creates also a very bearish environment for the dollar and very positive for hard assets. I have a very strong view that this is one of the most important charts for investors over the long term, is this structural problem of the twin deficits relative to GDP. And a lot of people who look at this chart said, but this is a normal thing to see when you are at the reserve currency. Yes, it's normal to run a certain degree of a deficit, but not a 10%, a double-digit deficit relative to GDP. This is a real problem for the U.S. Let's go to the next chart. And most importantly, because it doesn't really matter the governance, what we're seeing is government expenditures relative to GDP, excluding the payments or what they receive from taxes. We're seeing 44% of GDP today, which is as high as it was at the World War II. And you can see the upward trend of this level of a lack of discipline on the fiscal side. In fact, in the next chart, as you can see, we try to get sometimes political and blame one party versus another, but really both parties have been very negative when it comes to the stance of the deficit. I mean, the stance of the deficit has been bad in both parties. In fact, it's very similar to what we saw back in the 40s during the World War II in terms of what we're running of deficits. And I think this is going to be more and more of a problem and more of a discussion as we see perhaps even a Bank of England moment in the 10-year yield and a spike of the 10-year yield with elections and this sort of lack of work towards fixing the fiscal problem here. And I think this is becoming more and more relevant as well of an issue. Let's go to the next chart. I think I'm going to close up. I think, look, gold is consolidating, showing a chart of gold. Gold has been consolidating after a breakout from a triple top. I love this chart of gold because I'm seeing that the dollar is just so, it's just not moving despite the positive, environment for interest rate differentials and other things that I think it should be moving on. And gold has been consolidating at that phase, and I think we're getting ready for another big move. But I would like to close out. I think the next chart, let's see, I believe it's looking at this chart that I think is such an important aspect. I think there's one of the most historically unsupported views of the market today is this idea that the gold miners or gold itself can go a lot higher. However, the miners are not going to follow. And this to me is just a usual sign of a narrative that has been imposed by market participants that have not either participated in prior bull markets of the mining industry, or just because we haven't seen one for a long time, people have forgotten that when metal prices go a lot higher, we tend to see the gold miners starting to fundamentally improve. And that's certainly what we're seeing in the industry overall. Now, technically speaking, from a technical perspective, you can see in this chart, there's nothing like seeing higher lows in the chart, seeing what these businesses sell is gold, and gold prices are higher, already broke out to new highs. To me, this is the perfect setup that we're seeing here. And I would like to remind you of a phrase from Senzel, in which we had the opportunity to meet with him once, and I'll close up my presentation here with that. But essentially, I think Senzel made a really good point about where great money is made. Great money is made on where there is lack of liquidity and interest of capital into a certain business or industry or sector of the economy, and the other way around. When there are crowded positions and folks are conventionally speaking about certain subject like AI or technology in a big way, those markets tend to be highly efficient. It's very difficult to make great money, and so this is a type of industry in which there is certainly a very large number of investors that are extremely bearish. And when you think about the potential for those folks to change their stance to become more positive and actually drive prices significantly higher, is to me where the opportunity really lies ahead. So I think this is a chart that shows the significance of why we've been investing in the mining space for so long here, in our view about how this is really poised for a major breakout. And if that happens, I think it's going to accelerate the entire industry to the upside in a significant way. And a lot of positive developments will probably occur in this part of the market. So with that, I'm going to finish my presentation, but thanks everybody for watching, and let's keep on going with Quinton Hennigh here.
All right. Thanks, Tavi. Look, Tavi's enjoying a little sunshine. I feel like I need to get out too. Good on him. But this week, I've got to talk about a tough subject. Before I start with that, or before I talk about that, I'm going to start with a little discussion around, the perception around the gold market. Tavi pointed out, gold stocks haven't really broken out just yet. So it feels like we've been in the doldrums for quite some time. These are when I say gold stocks, it's look, some of the miners are waking up and they're doing pretty well, but I'm talking about the more junior level exploration stories and stuff, and they've been puttering along in what I call the doldrums. This is a picture that gives you an impression of the doldrums. These are the summer doldrums you see when basically down in the the very low latitudes, the tropics, there's basically no wind in the ocean. So there's very little in terms of waves and stuff. And quite frankly, the air is just kind of sitting there. It's, if anything, it's rising a bit because it's warming up, but it isn't blowing side to side here. Okay. It's not creating waves. And, it feels like that's what we've been in. The thing I would kind of remind everybody is at the same time in the middle of summer, we also get things like, go to the next slide, this, okay, which is just an incredible juxtaposition to think that there are places where the atmosphere, the ocean and so forth is just absolutely still, like quiet. And then at the same time we have places like this. This is actually a picture, a satellite image of Hurricane Beryl. And it just shows you the amazing amount of energy that can kind of come with that summer heat. Okay, well, everybody that thinks we're in terminal doldrums and we're just going to sit here forever, look at today. Okay, gold has got its act together. It's certainly got a lot of momentum at the moment. Silver too, other metals too. Okay, copper is doing really well. Even zinc, for Pete's sake, zinc's $1.36 again. I love zinc now. I just watch it like a hawk. It's one of my favorite metals. But don't forget that we can go from doldrums to very, very abrupt, high energy moves. And, with luck, we might see a summer like that. I'm not saying we want hurricanes, but in the market here for the gold space, it wouldn't be a bad thing to see some interest, some energy come into the space. All right. Well, let's go to the next slide. Just as a perspective, I've dredged this slide up once again. This is my slide to show how I view gold bull periods. And it's really a look back over about a 24-year period. Okay, so it goes back to about the year 2000. And you can see there's phases where the MACD, which is shown in histogram down there at the bottom, is green. It's positive. And these are very well-defined periods, and we are certainly in one. Over here on the far right, you can see the bars that have accumulated. Really, that started around March of 2023. We're in it still, and we're, like today, we're seeing gold with some very, very strong moves. Where do we end up? this could be one of those hurricane events. Like this could be one of the most energetic gold moves we've seen in many, many years, maybe in history, coming up in front of us. Any guarantee around it? No. But this at least gives you a little frame of reference for what can happen in the gold space. Okay, so each one of these green bars is a bull phase in the gold space. And you can see I've put in there where the gold price moved, and how much, like the 1.71x, that's how much gold rose from the low to the high during that period. It also shows you the duration in months of each of these periods. On average, they last about 2 years. And on average, the price goes up about 1.68x. So where did we start? Roughly $1,800 an ounce, March of 2023. And we're still moving. Okay, what does that mean? We could go up to 3026 pretty easily in this environment. Okay, no guarantees, but that's certainly a possibility given this look at history. All right, could be more than that, could be longer than that. Don't know. Okay, we don't know, but I think we're still in it, and we've got a lot of leg room. It's not over. She ain't over yet. Okay, go to the next slide. Now I've got to talk about, there we go. Unfortunately, a very disappointing event, actually 2 events in the mining space, and they both happened this year. Okay, you step back and you look at mining, and look, both Kevin and Tavi touched on it. It's undercapitalized, and I got to say, where I'm at in my career, looking at the mining space, and looking at the shortage of people in this industry, and this goes for everybody. I'm not trying to make excuses here, but geologists and engineers and so forth, even regulators, okay, that work in this environment. It's painful. It is truly painful. Okay, but we've now suffered 2 black eyes in 1 year. The first was when in the Kupler, the mine over in Turkey, the heap leach failed. Silver Standard Resources, SSR Mining, is the operator there. Look, this is a company that had a very incredible track record up until that point. Okay, they're not dumb people, and but something went wrong, and my gut just says it has to do with the lack of people, like qualified people, and the undercapitalization. That's just my gut. That's my personal view. Okay, now more recently, we've been faced with another heap leach failure at Victoria Gold, and this is up in the Yukon. Many of you have probably heard about this. If you haven't, I would urge you to get online and Google, heap leach Victoria Gold, and you'll find lots of articles about what's happened up there. But I'm gonna give you my view. I've done a little digging. It's been not quite 2 weeks since this happened. When was it? It was I think early last week. But I'm going to give you my view and a little bit of technical view on exactly what happened. Okay, so let's go to the next slide. Okay, so this image is actually it's an artistic rendition of the construction, or what the mine at Eagle deposit would look like over time. This was actually, I think, is dated from around 2016. Okay, so it's early days. It was at a conceptual level, or in terms of its economic study and engineering, I think it was at a feasibility level at that time. But it was, it was not built. Okay, I'll say that. This is all an artistic rendition. It shows you, we're kind of looking, I have my geometry right. I think we're looking east. I might have it flipped around, but I'm pretty sure that's the way it is. I think we're looking east or northeast or something like this. And the open pit over here is on the side of a mountain. It's basically where they derive the ore. You have waste piles, waste rock that's put in tailings piles around the open pit. There I go, using the word tailing. Sorry, Kevin. But tailings is simply a term used. Tailings can be a variety of materials that originate from mining. It could be waste rock, in this case, I'm talking about waste rock storage, right? It can also be mill tailings. It can be, there's a lot of different tailings. But over here on the left-hand side, you can see what is called a valley heap leach. Okay, this is hilly terrain through here. It's there's not a lot of flat ground. Okay, if you were in say Nevada or something, yeah, you could probably build your heap leach on a flat surface somewhere. You'd find enough room to build something like this. But in this country, they had to build this in a valley to make this operation work. This is standard, procedure. There's nothing like there's many valley heap leaches that have been built throughout time and around the world. So this is nothing new. It's nothing out of the ordinary. But this is what they intended the operation to look like. They would move the rock over to at least the gold bearing rock over to the heap leach, put solutions through it. The solutions would trickle through, and then they would collect those. It would go through the gold recovery plant down there at the bottom. You can see a little tag there. They would strip out the gold from solution, then reintroduce the solutions into the heap leach. Basically, just a chemical cycle of recovering gold. All right, pretty simple operation, and it's also cost effective. This is a good way to operate if you have gold ores that are amenable to heap leaching. This is a very low cost way of operating. All right, go to the next slide. Just for a little background, look, this is a slide taken more from a copper heap leach because it refers to SXEW, so solution extraction electrowinning. But this is the same that you can apply to gold too. I mean, it's basically the same kind of array of how these things work. Gold, they don't use acid, of course. They use sodium cyanide solution, but they sprinkle they stack the rock into lifts, and then they sprinkle solutions down through those. And those solutions, as they trickle down, they actually slowly dissolve the metal that's desired, that's trying to be recovered. And as they hit the bottom, they hit a rubber lining. There's a very strong impermeable boundary to keep those solutions from trickling further down into the ground where they're not supposed to go. Okay, the lining there is designed so that it has a slope, and that way the solutions run down into a collection area, a collection ditch or a pond, where they're taken then, pumped out, and put through a circuit, an electrolytic circuit, where you strip out the metal. Okay, whether it's gold or copper, whatever, it doesn't matter. But the point is, you take the solution, strip out the metal, and then you push those solutions right back up into the heap leach. Okay, so this is your very, very simple, really, in many respects. Yeah, let's go to the next slide. Now, I went back to the rendering that I showed you earlier, and I put a little red circle on the area that happened to fail. Okay, and we'll see that here in a minute. So it was kind of on the gold recovery plant side of the heap leach, right at the head of the valley. Okay, or the head of the toe of the heap leach facility, but at the head of the remaining valley that's left there. Okay, so this is an area where basically the rock was probably oversteepened or something happened. Okay, loss of friction or whatever. We don't know exactly. They'll have to study it and figure things out, but this is where it occurred. Let's go to the next slide. This image shows you, it's a little bit different angle, but you can see the little building. Oh, well, it's not little, it's a big building. That's the gold recovery plant over there on the left-hand side, kind of in that cleared area or flat platform. And then below there, you see a pond, a very long pond. I believe that's where their leachates collect. That's where the gold-bearing solutions collect. They would pump those up through the gold plant, strip the gold out, and then put them back up on the heap leach. The heap leach is everything that's kind of on the right-hand side of this image. So you can see that basically we have a place where the entire end of that on the side that's closest to the gold processing plant slipped down, and I'll talk more about that. It's called a rotational landslide. Okay, and not only did a block slip down, like it moved en masse, it slipped down. The material at the toe of that block actually turned into a flow. It did what we call fluidize. It's simply a term for what happens when materials, behaves like a fluid. It flowed like a river in a landslide. Okay, below that, and that landslide continued down It continued down to an area where there's some holding ponds a little bit further off the image here. I think the total distance from the head of this failure down to the bottom was like 1.4 kilometers or something. But it is a significant slip, and I believe, just spitballing it, it looks like this probably involves a few, like 2 or 3 million tons of material, something like that. Okay, this is a lot of rock. It's not as big as the one at SSR, but it is still a significant failure. And it turns out there was a smaller failure, as we're learning, I think in the recent press earlier this year. Okay, there was one, I think in January or February, and they referred to it as being on the southeast side of the heap. So I think it would have been to the right of where this failure was. Okay, but this is a concern. Things like this should not happen. By definition, this is a failure. It's not supposed to happen. The engineers who work on these projects are supposed to design everything just right. How the rubber mat goes down in the bottom, how it's all sealed up, how the foundation material is applied. This is material to reduce the coefficient of friction, or increase the coefficient of friction, make it stickier and more supportive. And then how things are stacked, okay, and including the angle at which they're stacked. You don't want to oversteepen it. You don't want to get too much weight that might cause something like this. But here we have it. It's failed. Okay, this project. This is heartbreaking to see, because there's a lot of people that poured a lot of time and effort and their careers and everything into this, and something went wrong. And we don't know exactly what it is yet, but it will have an impact on a lot of folks, not just the people that built this thing, but the regulators and perhaps others. Okay, so let's go to the next slide. A little bit about rotational failure. I actually took this slide from an academic paper. I had the reference up, and I don't know why it got clipped. Where the heck is it? It must have gotten shifted off of the slide. Sorry about that. Can't remember the exact reference. I'll have to quote it later or something. Apologize. But in the lower right hand side here, you can see a cross-sectional diagram that shows you what a rotational failure looks like. Okay, so you can see there's kind of an arcuate slip plane that develops there in the yellow dashed line. And the block of material in blue there, it moves in mass, it slips, it rotates. Okay, that's why it's called a rotational failure. And then off the toe there, you can see all the bright colors, the reds and yellows and whatnot. That's where the material fluidizes, and that's what flowed. Okay, so this is giving you a sense of what happened. Now, exactly where the failure initiated, my guess is it's probably the toe. I mean, the toe, whatever was kind of holding this block up, failed. Okay, like the foundational material or something, and the thing slipped, and this thing all happens almost in unison. So you get the block rotating, but you also get this fluidization event happening more or less at the same time. Okay, but irregardless, that's what a rotational failure looks like. All right, let's go to the next slide. Now, a friend of mine sent me some of the movies. There was a movie made when they were building the pad back in whenever it was 2017 or 18, I think. And it was just a promotional movie, and there were some aerial shots, and it caught my attention. A couple of things caught my attention. And I'm not saying I have any clue. I'm just about what happened here. I'm just saying it caught my attention. It's a bit anomalous. One of them was the fact that you can see the rubber mat there. Okay, that's that dark gray material that's laid out across that valley. Okay, it's a bit hard to see, but it's actually a fairly long valley, and the rubber mat has been laid down on the bottom of it. But over here on the on the side closest to the processing plant, they don't have the rubber mat down yet. And I found that interesting, because why would you wait to put that down? Usually you kind of like, I don't know. It just came off interesting that area has not been, lined yet. I don't know. Don't know why. But funny enough, that's where the things collapse. Does it mean anything? Maybe not. I don't know. It's just an anomaly that I noticed. And then go to the next slide. And then later in construction, I noticed another kind of anomaly. Okay, and that is here we can see a similar view. Not it's a little bit higher and a little bit further back, so we're seeing a bigger picture here. But you can see that the rubber mat has been laid down back through the valley there. It's all gradually sloping down, down into that kind of that low point there. But this side over here, closest to the processing plant, they don't have much compacted earth material on that mat in that area. I mean, it just struck me as interesting. Again, anomaly. And I don't know, maybe they put some more material on after this image was taken or something. I don't know. But it caught my attention once again. It does look fairly steep in that area too. Like if you look over the back area there, it's a little bit shallower angle, and you come around and it kind of looks like it steepens up right there on the processing plant. I don't know what happened. We'll probably find out over the next few months, but it's going to be interesting. It'll be interesting, and again, it's a very sad event to see because things like this are not supposed to happen. All right, let's go to the next slide. Okay, so I pulled up some info on heap leach operations. Look, I actually have a spreadsheet somewhere where it shows that there's roughly 300-ish heap leach current operating, but historic heap leach as well that have been built for gold on Earth. There's other heap leaches too. I talked about copper and stuff. There's copper heap leaches. There's even, like uranium and other things. But in terms of gold, there's been roughly 300 heap leach operations, either operated or are currently operating on Earth. There's about 120 mines that use heap leach right now. Notice this list of where they occur. A lot are in Russia. Okay, a lot are in the United States, mainly in Nevada, but some other locations too. Now Fort Knox actually is up in Alaska. It's very similar to Victoria in terms of its topography and climate and whatnot. Very similar. Okay. And that one's been operated successfully for many, many years. In fact, also Valley Heap Leach. So, this can work. But notice that Canada, interestingly, that's weird, isn't really in this list. Look, there are very few heap leach operations in Canada. Okay, folks. I'm not meaning to conjecture or anything here, but it does seem interesting that one of the countries that probably has the least experience, and their regulators and other folks, engineers and stuff, probably have less experience with heap leach than anybody that is operating in a big gold producing environment. And it happened here. I'm not throwing stones here. I'm just saying, interesting fact that this failure occurred in Canada, where there's virtually no heap leach. Okay, now let's go to the next slide. And let's talk about the impact of this, direct impact on the Yukon. And why would I bring this up? Because the Yukon has had a very cyclical up and down history with respect to mining. Okay, there have been some very large projects that did well for a while and then failed for some reason or another. Some of it was commodity price, some of it was other reasons. But there's been this cyclicity to the Yukon, and they've been trying hard to break out of that cyclicity. Okay, when I say they, I'm talking about the government of the Yukon, even the First Nations, and everybody recognizes that mining could be a very good path for the economy of the Yukon, for its growth, for its people. And to see an event like this is just absolutely heartbreaking because it affects a lot of people. It's not like a little deal. Like, this is huge. This is basically the heartbeat, if you will, of the Yukon economy in some respects. Okay, now there's only about 45,000 people across the Yukon, and maybe about 30,000 of those are actually of working age. Okay, now the mine itself employed about 500 people. And if you use kind of the rule of thumb that there's about 5 secondary jobs. These would be jobs that, effectively support those who are working in the mine for every mine employee. Then that would mean there's about 2,500 other jobs that are at stake here. If you add that up, you got about 3,000 jobs that are impacted, either like terminated or, like cut way back because of this event. That's 10% of the workforce of the Yukon. That's terrible to see. It affects everyone. It's just absolutely heartbreaking. We got to get these things right, guys. We got to get mining right. This is not good. It's not good for people. It's not good, for the economy. It's not cool. GDP. I looked up the GDP of the Yukon. It's about 3.2 billion last year, 2023. Numbers aren't final for 2024, obviously. And the Eagle mine, look, it wasn't quite at 200,000 ounces per year, but it was getting close. And if you just say, okay, well, that's about $0.64 billion of gold annually, that's about 20% of the GDP of the Yukon. Again, this is devastating. This is devastating to see. Now, does it mean all is lost? Okay, this is where I have to be very clear. I'm going to give my view. No, I don't think so. Okay, they must look into why this happened. There's no question. And they must find that answer. Okay, very clear answer as to what went wrong. I do think more mines will get built. I think that the short term, like the human psyche is always a bit panicky. And when they look at the short term, yeah, it's very disturbing to see something like this happen. But there's a lot of people in the Yukon that are working their tail off. They're good people across the board, government, the people that live in these small towns, like across the Yukon, Mayo and so forth, the First Nations, everybody has put their heart and soul into this. And I think they want to continue that. Okay. I think that's where there is hope. Now, what about this, immediate incident? Is there any coming back from it? Yes, there is. Okay, look, there have been a few, not many failures in heap leads. There's been a handful. And there are ways to mitigate it. Okay, you have to unload the pad, and you have to, usually you do it from top down. You don't want to start pulling material out of the bottom and have things fall further, but you basically just start taking the weight off. Okay, you try to, pull back the rock, and then you can redesign your heap leach. You have to reline it, and the whole works. You can make it work, and I think that's doable here. I've talked to, some people that I know in the Yukon, as well as, other technical people who know the project well enough, that most people's view is that this thing can be resurrected. Now, it does have an immediate impact because, unfortunately, those people that were working there aren't going to have jobs for a while, nor those secondary jobs. In other words, there's going to be a direct impact here. How long might it take to kind of resurrect things? With luck, maybe a couple of years. I don't know. Just a guess. But I do think it can be resurrected. The people that loan, what do they call it? Victoria money to build this and operate, there's going to be some intestinal discomfort amongst a lot of the creditors, but life happens. Now, I really hope that whatever lessons that are learned from this can then be applied so that more projects can go ahead, and quite frankly, mining will be successful here, because it is successful in so many places. Okay, there are so many areas, regions, districts across, like the U.S. here, Nevada, northern Nevada, for example, where we haven't had issues like this, and I don't think they should occur. They certainly can be designed not to occur. Okay, we need to get that kind of comfort back. Okay, baby step, kind of fell on our nose, but I think the future of mining in the Yukon is good, because you have people that want good things for themselves, their families, the future, et cetera, and you also have people that are very dedicated to making things work. Like, I don't mean to throw stones at anybody here, because it's so tough to see this, and we don't really know what happened, but stuff like this can't happen. Okay, we have to get it right. As a mining industry, we have to get it right. one of the things I'm really pushing for is an increase in education in the geosciences, particularly geology and engineering. And I've been working my tail off with the School of Mines here to try to shore up, build up more people, students, young students coming into these areas of study, because like Kevin and Tavi showed, we need metal. We need metal. Mining has to happen. It has to happen. I don't know any other, answer for how we're going to get all the metal we need other than mining, at least for right now. Okay, so the world, guess what? We need mining, and we need people who come into this industry, because you can't run it without. So that's my 2 bits on everything that happened. All right. Okay, let's go to the next slide. Okay, we're going to talk about a few updates, just a handful of updates. And the funny thing is, the first one I'm going to talk about happens to relate to the Yukon. Let's go to the next slide. Okay, Sitka Gold put out news. In fact, I am pretty sure this news release came out the same ding-dang day that all of this happened at the Eagle deposit. Okay, so it was 24th of June. That was about a week and a half ago. All right. Sitka announced they expanded their RC Gold project. And guess what? They acquired the adjoining ground at RC from Victoria Gold. You might say, well, look, this has absolutely nothing to do with the heap leach collapse or anything. This is a deal that had probably been underway for months, weeks, months. I don't know. It's taken forever. Just coincidence that it happened to come out. The announcement came out the same day as this heap leach. But, the fact that Victoria was willing to let go of this property, which is pretty prime property, for effectively a share interest in Sitka, tells me that Victoria really had no ability to spend money on exploration. And they were more eager to hand it off to somebody who did have money and did have the passion than to pursue it themselves. And that's not unexpected when you have a company that's kind of living hand to mouth and doesn't have a lot of cash on hand. They don't have the ability to grow. That's a whole different debate. It's a tough industry, but look, Sitka, by picking up this ground, I think it did the right thing. They have an amazing consolidated property position now. We'll take a look at that with some actually outstanding results, drill results. Look at that, 20.46 gram gold over 10.7 meters. Kevin and Tavi, there you go. Discovery level hole. Boom, right there on a piece of ground that they just picked up. Okay. The next one over 1.87 over 42.6. Not quite 100 gram meter, but pretty dang close. Okay. And the others below. Anyway, we'll touch more on that in a minute. Go to the next slide. Okay, these two maps simply show you a before and after picture. So that blue block that's shown in the left-hand side, upper left, that's the piece that Victoria Gold held. And it's not a small block. Look at the scale bar down there, just above the name Sitka Gold. Okay, that's a 12-kilometer line there, the black and white line. So that block up there is about 6 or 7 kilometers, I think, east-west, and then another 6 or so kilometers north-south. That's like 36, 37 square kilometers or something. It's a big piece of ground. And on that ground are actually some of these reduced granite intrusions. Okay, so it's a natural fit how these two, the geology is seamless across the two. Okay, so to see it consolidated, I think is a wonderful thing. You can see that in the right-hand image here. Go to the next slide. Okay, and then this is a close-up of that area. The yellow in this case, or the yellowy orange, is that Victoria Gold piece, and this gives you a zoom in on the area. You can see the reduced intrusions and the red stippled patterns, and you can also see some purplish ovals where they highlight areas that were drilled. Okay, so there have been drill holes in 3 areas here, 3 notable areas: contact zone, the Roscoe zone, and then this bear paw breccia zone down in the southern area. Okay, and there's some pretty darn good numbers down there. I mean, like that bear paw, look at that, 48 point something meters of 1.69, 52.9 to 2.25. Look, I love grade in these reduced intrusion systems, and I've said this many times. I'd like to see grade. It's the ones that have grade that are going to be the most in my view, the most productive and probably the most profitable. Okay, and that's why I like Snowline. Okay, the other thing is you're probably not going to heap leach higher grade material like that. You're probably going to have a milling operation. Not that that's the be all and end all. Like, I'm not trying to, you know, cast one against the other, but I'm just saying this would probably, with higher grade, probably not going to do heap leach. Okay, you simply wouldn't want to lose that gold. And the heap leach, you might get 60%, 70% recovery if you're lucky. Yeah, you're not going to throw out that much gold. So you're definitely going to want to focus on milling. Look, that contact zone, that's where that high grade is. Okay. We know already up in the Blackjack deposit, they've hit some pretty high grades. Those 2 holes they had earlier this year, those were really strong intervals, and they're leading down to the south there to that Puckelman, I think it is, stock, or in that area. These are all connected, guys. Just think of this as like imagine a cow tipped upside down and the udders are poking up in the air. Okay. That's the way you should think of these reduced intrusions. They all lead down to effectively one mothership. They're all connected. Okay. Go to the next slide. Okay. Shortly after this, in fact, this week, they announced an expanded exploration program, and that is going to be dedicated to this newly acquired Clear Creek property that they acquired from Victoria. Okay, let's go to the next slide. I realize I'm kind of dragging here, so I'm going to move it, step up the pace. Okay, so here we can see some data presented. This is a very similar image to what I showed a few slides back. It shows you all of those previous drill areas. Those are those purple ovals that you see in there. They're kind of hard to see with all the colors there, but they also have soil data that they've extended from the previous part, their existing RC property, down onto the Clear Creek property. And you can see the continuity is seamless. Okay, the gold system just right across the boundary. There's no question that this was a critical piece of ground that is absolutely certainly part of the overall system. Absolutely no question. Okay, this is one of the biggest reduced intrusive systems I've ever seen. Okay, I know Valley, wonderful deposit, wouldn't disparage it one iota. It's a wonderful deposit, and I think Snowline is going to make additional discoveries as well. But I've looked at a lot of these things. I've spent a better part of my career farting around with these types of systems. Okay, way back in 1992, I think it was. I worked at the Zhoroy deposit, which is in Kyrgyzstan. It was right after the Soviet breakup. And I think I worked for MK Gold at the time. Learned about reduced intrusions the hard way. I mean, I went to Fort Knox the day they opened the mine. I was up there. That was 1995 or 6, I think. I spent quite a few years chasing these things in various parts of the world, Nevada and elsewhere, and Montana and all over. Anyway, I know these systems, and man, when I'm telling you, when I'm seeing a big one, a big strong one, this is a big strong one. It's got the grade. Okay, grade. Anything that's kind of 1.x gram, or heaven help us, if it's 2+ gram, systems that make those kind of grades, those are the winners in this type of geology. All right, and I think this property is going to pay off in spades for Sitka. I think there's a wonderful acquisition. Go to the next slide. Okay, this shows you a close-up of some of the drilling at this Rosh Gobel. I don't know how you say it, Rosh Gobel intrusion. And these 2 holes in particular, 50.3 meters, 1.07, 67.1 meters, 1.03. These are shallow RC holes. They're RC holes that were drilled eons ago, like I think in the 1990s. Okay, why Victoria hadn't done anything? Well, they didn't have any money. Okay, so let's look at this in cross section. Go to the next slide. Now let your mind wander. Okay, just for a second. Okay, look at these holes. They're very shallow, but those 2 holes right there in the middle, those are the ones that hit those long intervals. The guys here at Sitka think that there's a corridor. Basically you have a deposit inside of this giant intrusion, and they only nicked the tippy top of it. Okay, imagine you could fit a valley or two in this image, right there. And they want to drill big. Okay, they think big. I love this. Okay, thank you so much. Core and his team we must use telepathy or think alike. I don't know, but look at that hole they have planned, 24A. Look at that blue line. It goes clear across the whole shooting match. You think that might hit some? Look, if there's a big zone of gold here, that could be a killer hole. Okay, maybe we see a discovery here like Valley. Okay, something like that. Wouldn't that be cool? All right, go to the next slide. Okay, they're also going to do work, boots on the ground work. Now, this image is slightly shifted northward. Okay, so the yellow jiggy jag line is the Clear Creek property. That's to the south. That's where those new intrusions they have are. And then we can see the area to the north where they've been drilling, like the Blackjack deposit, Niagara deposit up there. This is all part of one big picture, but you can see now their overall plan here. They know they have some really good numbers out of this contact zone. You know, that 10.7 to 20.46. Man, when I see that, it makes me think. I remember at Giroy, we had a high-grade plum in there. It was kind of a structural zone, a banana-shaped structural zone in Plainview. And it probably had 2 or 3 million ounces at a very high grade, like 15 gram or something. Okay, if they have something like that here, that can make a mine right there, just that. Okay, there's also other intercepts here, 28 or what is it, 38 meters, 1.54 gram, 74, 1.1. Those are nice numbers. Great. And we're seeing it. These guys basically want to test this area, start pulling this picture together here. We should have a lot of really nice news coming out of this company over the next few months. All right, go to the next slide. I'm almost done, guys. Okay, Lion One had an announcement that included an update about production and the mine activity, as well as some exploration news. Okay, and I found this encouraging. Okay, to refresh everybody's memory, Lion One is in they're not at they're, I don't want to call it experimental, but they're ramping up what started as an experimental mine, and now they're ramping it up to we'll call it more of a commercial scale mine. Okay, and you can see the production has gone asymptotic here. Won't continue forever. You can't just go up and up and up, but at least we're seeing them ramp up gold production to a pretty respectable level for starting a mine from scratch, putting declines down, having a lot of development work too, and then to start to see gold come out more and more so here. Very encouraging. This trend, I think, is very healthy. It took a little bit longer to kind of get this ramp up in. I'm not being critical of anybody. It's, I know that they've been working their tail off down there, but it is really nice to see this finally come to fruition. And I certainly hope that their creditors appreciate this kind of performance, because I think that they can make it. I think this could be a very good success. It reminds me of how K92 got started. Like it started out a bit slow, and they kind of had to bootstrap things, cowboy. But then look at K92 now, very successful operation. Maybe we can have a similar result here. Go to the next slide. The mill, the throughput has been ramped up as well. June projection shown in red there. I don't know what the final number was, but it's about 11,000 tons per month right now. Okay, and if they can hold that, that's quite a bit. That's a bit over 300, almost 400 tons per day. But they're going to ramp up further. I think they're going to shoot for 600 or 700 tons per day. So I think we'll see this resume its upward progression. Go to the next slide. And then on the exploration side, they had some really interesting results. Now, this is to the south of the Tuvatu vein system. You can get a sense of the lodes and the workings up there in the pink squiggly lines. This is basically golden soils. Yeah, there was some data down here, but this really fleshes out the data better. And you can see there's a natural extension of the Tuvatu vein system. I've always felt it could extend in this direction. I'm glad to see him do the work. The topography does rise a bit there. I think that was the biggest challenge for drilling here previously. But look, that could double the footprint of the Tuvatu system right there. Go to the next slide. And then they restated, there we go. They restated the resource. This is really just a rehash of the resource that they came out with, I think, about 3 or 4 years ago. It's not really that big of a change. I think the grade has actually improved a bit over that one, using a 3 gram cutoff. You kind of compare apples to apples. But, right now, this is a good place for this mine to be. It's got about a bit over 500,000 ounces indicated and inferred. Like, you're never going to have a measured and indicated exclusively like a big number for a deposit like this. This is how you grow deposits like this. You start with this, you open up new ground, open up new lodes, drill some more, you go a bit deeper. Look, a lot of that stuff that was hit a couple of years ago, the high grade, ain't even in here. Okay, so yeah, this thing will grow. Not too worried about it. Some people are like, I don't fuss too much. Fosterville, for example, for many years didn't have more than, say, 200,000 ounces in front of it, and look at what happened there. Okay, go to the next slide. Okay, and then one last note. Nevada King put out some news. They're finally drilling this East Ridge target, which lies east of the pit at Atlanta. I hauled my big ass up there one time a couple of years ago when I went out to site. I've walked up the switchback roads, pretty steep hill, but I managed to get up there, and I think it looks like a very attractive target. In fact, this block might be the upthrown half of the Atlanta deposit. They did some geophysics on this, the geophysics being CSAMT, and they can see a pretty compelling anomaly here. They are drilling there now. Don't know what they're hitting yet, but we'll probably find out soon. Go to the next slide. The CS to AMT, though, shows that there's a corridor there, though, of rock that if you start over on the left-hand side, okay, there's the WAGZ, but there's the AMFZ, basically it's the fault zone, the Atlanta fault zone. See that blue corridor? Look at that rock steps over. That's my impression, is that the rest of the ore body could be actually uplift over here to the right. My two bets. They are also arguing that this cross-cutting feature is squeaking its way up there could be an intrusive plume. And I think it's a structure, but whatever. The point is, if they hit here, this could blow this thing wide open. It could actually expand this thing dramatically. So let's see what they come up with. Okay, there. I'm done. Sorry, dragged on too long, but I'm done. Done.
All right, thanks, Quinton. It's kind of a holiday weekend here. I know a lot of you are probably on vacation already, but thanks for everyone for tuning in. The markets are open today, and it's nice to see the precious metals markets are really doing well here, because like Tavi was showing, that ultimately is what's going to drive the stocks here, and the stocks are lagging. It's a huge opportunity. We have a killer portfolio of over 65 companies with and over 60% of these companies have bona fide discoveries in Quinton's estimates, and that's using Newmont's criteria for 3 or more 100-gram meter drill intercepts on a gold equivalent basis. The world needs this stuff, and we've got gold, we've got silver, we've got copper and zinc and nickel. It's an exciting portfolio for the modern world that needs metals, that needs inflation protection. If you're interested in being a part of our strategies, give Merrick a call here. He can reach out to him via email, however you want to reach out. We can tell you more about our strategies and what might fit with your needs and circumstances. And we'll be back again soon. Tavi, any final comments here?
No final comments necessarily. My internet's not as great, but great presentation. It's nice to see the metals moving, as you said, and I'll re-emphasize what I said about the yield curve inversion. I mean, pay attention to what's going on there. I think that's a good. When you go to the doctor, you have all sorts of ways to look at your body to see what the state of your health. That's how we measure the state of the health of the economy, and that usually is in a world where we have the Fed's dual mandate where they have to find the stability of inflation and labor markets, and at the same time we have the debt service ratio surging as much as it did. I'm very positive they're going to find a way to justify interest rate cuts and other things in order to reduce that pressure from the economy, and that's what creates a supercharged environment for hard assets, which makes me super excited. So businesses that produce that will at some point start fundamentally improving, and we should see the reflection of that in prices as well. So it's a very exciting environment to be. It's such a niche strategy that we have, and that's it. I thought I didn't have a comment, but here it is.
All
So,
right.
see each
All
other.
right, and check out our investment letter too on our website. I've got a Twitter thread on it as well. We do see two major catalysts for a recession right now, and one of them is the innovation from AI, and it's the creative destruction aspect of it. Look up creative destruction. Go study your Austrian economics, and it's a good thing for the world in the long term. It's fantastic, but to really get the real economic benefit from AI, we're going to have to change up, some of the incumbent business models that are the monopolistic type business models that are not really allowing the rest of the economy to grow. The new disruptors are the ones that these new innovative companies that will challenge the existing monopoly mega cap tech regime. So be on the lookout for that. And the second major catalyst for this recession is inflation. And we have inflation in spades. And when the Fed cuts interest rates into an inflationary environment with the debt and deficits that we have today, I mean, watch out. We've never seen this type of a setup before, and so how can we possibly have a recession when the economy looks so good? Well, two things: inflation, creative destruction. Check out our letter, and we'll see you again here in another week. All right, so signing off.